Hey, it's working. Can you hear me? Can you hear me now? We're having some technical issues. Sorry, I should have turned that light on, but when I turned it on before, it was kind of glitching out the camera there. So welcome everyone back to the Mike Rosehart show. We're live again, this time from inside the cottage where I'm staying. I am sort of homeless in that I don't currently own a home. But yeah, I want to talk today about stock hacking. I don't know if you guys can hear me. I don't know if the Wi-Fi, someone just jump into the comments and let me know if it's working. Let me know if you can hear me, loud and clear or not. Last time was all right. We were outside and it seemed okay. Today, I don't know. It remains to be seen whether or not to be able to see me. Okay, perfect. Cool. For a while, it was just spinning, saying trying to connect. So that's what you get in rural cottage country internet. So trade-offs, I get to spend the day trading on the beach and being with my three girls, and it's awesome, but there are trade-offs. The internet is slow. I want to talk about options trade a little bit today, talk about what's this ugly thing you see here. I know. I do usually never have long facial hair, but I am currently on a pact with myself that I will not shave. I can't grow much anyway, but that I will not shave until I have completely rectified the mistakes I made with that Newegg short, and I have to punish myself. And so every day I wake up itchy, and it's brutal, especially in the neck area. I have, to give you an update, it's been, 2 weeks, I think, since the lows of the Newegg short, where I got margin called and my entire portfolio got liquidated. I learned a lot through that experience. I was down, at one point, I think $1.7 million. I can say that I've recovered more than half of that. We are, I think, 300,000 off of my portfolio value in May. So I'm getting closer. Unfortunately, part of the learning mistakes that part of the learnings of that short was that, hey, I can't naked short anymore. And so to make back the 1.7 million with the new risk parameters that I have is very, very difficult. I have to be actively on my phone looking for those really juicy theta decay type deals. I want to talk about options trading in general versus real estate, because I've seen a lot of posts this week from, both. I dabble in both. You guys know I'm a real estate investor at heart. That's what I built my brand around. That's how I built all my wealth, multiple millions doing real estate investing, right? I was able to find opportunities where others didn't see them in real estate, and I still do that now. Like, I actively still have, a couple dozen projects in real estate on the go. Like, I've got a good sized buy and hold portfolio, despite the fact that I talk shit about real estate these days. Real estate's a fantastic, active business where you can build a lot of wealth with a little bit of capital. However, once you've built up a sizable amount of capital, you can grow it faster using methods like writing insurance contracts, using stock options on blue chip quality stuff on the down days. As an example, on my Instagram stories at Mike Rosehart, you can see I did a post. Someone said, give me an example, Mike, of where you can take almost no risk and make a great return. And so I just clicked on Tesla, because Tesla was open. It was down 4.5% on the day, which was the low on the day for that stock. Now, you guys know I'm not a huge fan of Tesla. I love their products. I like all of that stuff. However, I think that they're overvalued. They're trading at a future multiple that is, they have a lot of targets still to hit before they'll reach the current market valuation. And so I went and picked, write an insurance contract. You could sell a put spread at 300 and 250. So if the stock goes below 300, I agree in 3 weeks to buy the shares at below 300. It won't go below 300. It's just not what's going to happen. The momentum and the energy, and there is so many resistance levels between the $650 to $700 a share Tesla's at, down to below 300. It just won't happen in 3 weeks. Anything can happen. I mean, there could be a world recession, which is why we're buying a put at 250. So we're capped out. If it goes below 300, then it zips down to below 250. We're good. We've stopped out. You never do anything naked. But it was paying 34 cents a contract, which people are like, oh, that's terrible use of your cash. But you actually tie up so little margin in cash. And by the way, it was up, I think, 60, 70%. Premiums were paying 60, 70% higher than the day before. And so a 4% quick dip in the share price caused, in the options world, a 60% increase in premiums. That makes no sense. That quickly corrected within 4 trading hours. I was out of the contract the next day. And that's an example of like a 25% annualized return with almost no risk, because owning Tesla below 300, I feel like, given they just had a great quarter, over $1 billion in profit, right? So they're growing, right? And they're doing well, and they're hitting a lot of the benchmarks. And I think they eventually will get to a valuation of over $600 a share. They're not there yet. You're paying for some growth and some potential, which is, a lot of investors are okay with. I'm okay with a little bit of Tesla in my portfolio. But as an example, you can write contracts on blue chip stuff or the S&P 500 itself. Literally on down days, you can write contracts and say, hey, I will buy the S&P 500 at 90% of its current value. And on a down day, that can pay you a 24% annualized. And you can do that on a weekly basis. Go on, log on your phone, Interactive Brokers, and write a put contract or a put spread ideally, because in case it goes more than 10%, it goes a 30% drop, and we have a COVID, type reaction where the world goes into cataclysmic, everything just falls off the rails. You want to have protection. And that put that you're buying to protect your downside, when you sell a put, you agree to have the shares put into your account at said price if it drops that low. If it doesn't drop that low, you get money for nothing. The hope is you get money for nothing. But sometimes you get assigned, and that's okay, because in a recession, you actually want to own the equity. That's the time you want to go out and buy the equities, when they're on massive sale. When everything is down 20, 30%, that's when you start averaging in. That's when you start buying. Right now, everything's at an all-time high. So I don't feel like it's a great time to be nibbling away at equities. I feel like it's better to write contracts to say, hey, I'll agree to buy these shares at a proper valuation where I think that they're worth. And there's someone out there on a down day, especially when the market's irrational and fearful. And by the way, there's a segment every single day that I rotate into where it's down. Something's down. Like yesterday, everyone, the market was doing well. What was down? Amazon. I wrote some Amazon stuff, some Google stuff before earnings. At like 20% off the share price. I cashed it in, 80% realized today. Easy, free money. Like, they're solid companies. The worst case scenario, I don't mind owning at significant discounts, and it isn't going to happen probably anyway. So it's just free money. I closed it out the next day. So annualized, we're talking triple digit, right? The best thing is the liquidity, I think, in options trading. When I do private lending and I give someone an agreement, let's say it's a juicy thing, like a 15% private mortgage. It could take me 6 months to 9 months to default on them and through a court judgment get my money back. In the options market, if things go sour, I got my money back instantly, like, plus 2 days to settle, let's say. But, the trade happens, boom, it's done, I get the money. There's no liquidity issues. Risk-wise, if you're using options contracts properly and you're taking on vertical spread, so if you're going to short with calls, make sure you buy and sell a call so your risk is defined. You can't lose beyond, you never short naked, and I don't think it's even smart to sell puts naked unless you're way, way out of the money, in which case, like, even still, in a cataclysmic event, if you had also bought a put to protect yourself, that put becomes super valuable in a black swan event. You can sell that to get liquidity to buy more of the dip. So it's always good, I think, to do spread trading as opposed to just going in naked. I'm going to address some of these comments in a second. Someone said, Mike, join me in the AMC short. Maybe saying this for a while. AMC has been propped up for a long time over its intrinsic value. It is growing with the new capital that it has and the new tension that it has. It is a long-term company. Like, I think AMC will be around for a long time. The movie theater experience is amazing. And I, for one, love the experience, and I could see continue to pay for that. And I think as people recover back to normal, that stock will do well, but not relative to the current price. Like, I love AMC at $2 a share, at $5 a share, even at $8 a share. I'm like, okay, but at $40 a share, no, thank you. It just makes no sense. So I actually do have open bear call vertical spreads on AMC. I actually have one bull as well. On the down days, I'm like, hell, I'll write a bull spread as well. And just with the volatility, I make money whether it goes up or down. I just sort of ride it either way. I don't really care. I'm stopped out either way. That kind of trading is more of a theta decay play where you write a contract and you agree to something, but as time goes by, that contract becomes less and less valuable because, I guess more and more valuable to me if I sold it, because I can now sell it for less and keep some of that premium for nothing. I could sell it to someone else. Now they have that contract, and we agree that we agree to sell it, and that I have no responsibility to have to buy those shares, right? I want to share on this story about how much, I have a plan to make $1 million a year for the rest of my life. It'll obviously increase as my net worth grows, but it's one of those things where the amount of work required for me to do that in the real estate world, and the amount of stress and risk associated with that, it's just so much easier to be on my phone, options trading, getting the same types of returns to a buy and hold portfolio. In fact, probably better because of the leverage I can use from interactive brokers. I can borrow at less than 1% interest. It's like 0.6% interest, which is prime, almost prime minus 2, a little bit less than that, but or a little bit more than that, sorry, interest-wise. But that kind of cheap money, you know, if you're very careful with it and you don't take large risks and you don't short Newegg naked like I did, and you take defined risks like I'm doing now, defined gambles with long-term play horizon focus, like the worst case scenario being your assigned shares. If it goes in between the price, your assigned shares in companies you want to own. And the hope is that when there is a big dip and you do get assigned, that you know that long-term you've built a portfolio that you can then ride out any recession. And that's the play there, right? Is being able to be comfortable with that. And so don't, you know, obviously stock option trade with all the money you have. Don't do anything with all the money you have. Not real estate, not stocks, not crypto. Do a little bit of everything. Anyone who says like all in one thing, I'm always skeptical and leery. I am a king of diversification. Many streams flow more water. It's safer. It just, don't take those kinds of risks and put yourself in those positions where you're, you know, you don't want to set yourself up for failure is the point. And that's a learning outcome. And even myself, sometimes I, you know, ego or greed or whatever else, have let myself, you know, nibble a little too much of a certain company, a certain share price, and you know, it is attractive, and I nibble a little too much, and then my asset allocations don't make any sense. Okay. Let's see. Hi, Mike. Hey, David. How you doing? Leventhal, alive and well. Perfect. Good. You can see it. We can hear you loud and clear. Good, good, good. Back to $20. So William's talking about the Newegg. So Newegg closed today at $19 and something, which is exactly where it started. Actually, I was above that price when I started shorting it. So it's actually gone all the way back to where I thought it would. The problem is I got margin called and basically was forced to hedge and take a $700,000 loss at $78 a share on Newegg. And I couldn't continue to hold my short. So I locked in losses automatically because I didn't do it with a proper hedge. I didn't set up a vertical spread. There's a number of reasons about how that went wrong. I tried to get offers accepted, didn't put them in at market, you know, was trying to adjust my bids, made a lot of mistakes along the way, and took an active trading approach, which is not what you want. You don't want to be an active trader. You want to be looking with a long-term lens. So you can actively trade on stuff you want to hold long-term, with the bet being that the worst case scenario plays out, that you own the shares and stuff that you want. You can run the wheel. Running the wheel means selling covered calls on it, own the share, get assigned the shares, and then sell covered calls on it until you're, you know, back to break even. Long term, that's a solid play. Hard to lose money doing that, right? So that's something that I lost my way on. You know, greed or whatever else. I don't know what happened there, but ego was probably a big piece of it, and premium chasing. Part of it was just like, when it went to $30 a share, I was like, hell, I'm doubling down. Like, this is even more of an irrational market. And it went to 40. I was like, okay, I'm tripling down. And then it just went to like 70. And I was like, okay, I'm done. Like, I'm stopped out. Did not know that they would actually margin call everything. I didn't realize that the brokerage basically says, hey, there's too much risk here. We're going to freeze your margin. And I thought you could continue. I could continue to be short on margin. I'm like, oh, I have a ton of margin room. But then they just froze my margin. And they're like, you have no room. Like, all you have is the cash you have. So they're like, start liquidating positions. It became a nasty thing. But yes, in the end, my Newegg short would have produced me all of my $1.5 million back and $300,000 profit had I been allowed to continue to short all the way till now. I actually got out of the short. I'm barely in it. I have a little bit of, I have some puts that I sold in it, and I have one vertical bear call spread left on it. So it's a shame. If there's another pop maybe on Newegg, I might continue to short it back down to, I would say like anything below $15 is more reasonable for Newegg, but anything over 20 makes no sense currently based on their current earnings, based on their current revenue, based on just like even like market dominance. Basically what I look at is current sales and current earnings, and then the trend on those as well, right? That to me is super important. And then what are the sort of competitive advantages that they have? And Newegg doesn't have necessarily a huge moat that makes it, you know, impervious to any competitors. It doesn't have that, right? So it's just not something that long-term I feel like has as good of prospects, and especially not at current prices. You don't want to see things at like, there's some companies trading at hundreds of times multiples of earnings. You want your earnings per share to be like, well, I mean, the whole market, I think, is a bit overvalued, but a lot of that comes back to how cheap debt is right now, how much free printed money exists in the economy right now. People are like, where do we put the money? There's just so much printed money, and money's so cheap, it's like free. Interactive Brokers is like, here, borrow 3.34 times up, at prime minus almost 2%, like literally almost zero. Soon they will pay you to take their money. Like, please take our money because the cash is worth less. It's a scary situation. There is a play there where this corrects and we go into a deflationary market as well, where no one wants to give up their cash. So who knows what's going to happen? I don't know. Always be ready and be nimble, but focused on the long term. We know long term that if you have a solid, diversified portfolio of equities or indexes that you own, you'll be okay. 5-10 years from now, it'll be much better off than it is today. And I think exposing yourself to some international equities is key in that too. So in diversity, there is a lower return, but then much more safety. If you own a little bit of everything, it's hard to get. You can never say, "Hey, my portfolio got blown up." The whole world got blown up. Like your portfolio. If I say that my portfolio got blown up, there was a problem with my portfolio. I didn't have a good asset allocation. I probably had like 5 stocks that I was heavy in. Right. That's the problem. Is that I didn't have a large collection of stocks and good stop loss and risk management in place, right? That's the real issue. Okay, so next question was, Eric, good to see you on. Brian says, hey Mike, what are your thoughts on the Scotia private banking, wealth management, leveraged stock portfolio versus Interactive Brokers? I have both. So I actually have a private banking with Scotiabank. There are some cool perks. I had private banking with BMO as well. And I've looked into it with CIBC as well. So I have no context on RBC or TD's private banking or private wealth banking. Typically it starts at 1 million to 3 million net worth. Some of them start at 5 million net worth. They don't really treat you well until you're above 5 million typically. But there is some, a little bit of red carpet treatment where you don't have to go into retail. Like I literally just call someone, or I actually send an email because it's easier. I email them like, hey, can you bring a draft out of my account? Can you courier a draft to my lawyer closing a property? Like I don't actually go to the bank and get a draft. It's all covered, it's all free. They literally courier it to the lawyers. That's a private banking privilege when you have private banking perks. You can have private banking, you could pay for private banking and have no investments with them. That's not what they want, but you in theory could pay the $100 and something a month. They'll comp it for you, they'll pay your plan fee if you have a significant portfolio with them. There's some good advisors and stuff in the Scotia world. So yeah, I could definitely give a referral to who I use. But I don't know, I think if you're a savvy investor, paying, let's call it 1%, it might be a little bit less, a little bit more, but like 1% of your 1% fee to an advisor to manage it, plus a management expense ratio on any funds they put you in. If they build you a stock portfolio, there's no drag there, but there could be an MER, management expense ratio, built in any mutual funds or ETFs that you own, and they'll typically put you in Scotia mutual funds or ETFs. And so there's that guy's getting paid through the management expense ratio and your advisor's getting paid. And in some cases they provide some value, but if you're, financially savvy, you could in theory, get very little value from the private banking side. But what's cool is this. So they set up a line of credit at around prime. You can get maybe a little bit less than prime, but basically they'll set it up at prime. And my understanding is they'll set it up at prime and give you 70% loan to value on a blue chip portfolio. So let's say you gave them $1 million. They'd probably be more than $1 million if they'd want to consider this, but let's say you give them $1 million, they'll give you a line of credit for $700,000 on your stock portfolio. And if it appreciates to $2 million over time, your stock portfolio, they'll increase your line of credit to 70% of $2 million, which is $1.4 million. And that'll be at prime. And that's a line of credit you can use for whatever you want. You can, go buy a house with it, whatever. You could take the cash and reinvest with them and then borrow. So you could put $1 million in, they'll give you $700,000 line of credit, then you can take that $700,000, give it back to the advisor if you wanted to, and then borrow 70% of $1.7 million, right? Which is going to put your thing at like $1.5 million line of credit. And then you can take the extra now $400,000 a room or whatever, and then use that to buy a house. Or, you can double down. So basically they give you 3.34 to 1 leverage on your capital if you continue to reinvest the increased line of credit that the bank is giving you. It's kind of cool in that, so one big perk when I'm comparing Interactive Brokers to like a TD or Scotiabank private banking, they'll both give you 70% loan to value. They'll take your portfolio and say, hey, we'll give you a line of credit for 70% on that stock portfolio. That's cool, by the way. If people are investing without leverage on their stock portfolio, like your stocks are like a house. You can put a mortgage on them anytime you want. Continue to own them, continue to get the dividends, continue to collect all that appreciation on those stocks, all those capital gains. But you can have a line of credit. You don't even have to use it, but it's there. And in a recession, you could use that line of credit to nibble down at all those good names that you like at 30% discount. Num, 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 right? That's exactly what you want to do with margin, ideally. Or you could use it. You could take $1 million from selling a property and put it in a stock portfolio, borrow 700 back, and buy a bunch of real estate again. And have the same amount of real estate you had before, but now you have $1 million stock portfolio as well. Now, the $1 million stock portfolio has a line of credit tied against it. So pro of the banking side is a margin call is when, so to give you context of what a margin call is when your stock portfolio dips below the value in which they've secured against it. So let's say in this case, they secured a $700,000 line of credit against $1 million stock portfolio. Let's say we have a big recession and your stock portfolio, went up to 1.1 million. Now it's down to 800,000 in a recession. And so you're 200,000 short technically. They will begin to liquidate your positions, but the way the margin call works with the banks, typically your advisor can finesse a week or two leeway. So you have a little bit of time to make a decision. And a good balanced diversified portfolio has some gold plays in it and some recession plays. And ideally what you do is you liquidate all those recession plays, which are now up, to get cash to cover your margin call. So you got to pay down your line of credit about 70% of the drop, basically. If you've maxed out your line of credit, you'd have to pay 70% of the drop back. So if it's now $800,000 portfolio value, you're down 200,000. It's 200,000 times 70%, which in this case is $140,000. So you need to raise $140,000 until the market recovers to pay down your line of credit. Whoa, am I connected? Can you guys hear me? It just gave me a notification saying it preferred to switch over to my cell phone data. Are we on cell phone data now? Curse you, rural Wi-Fi. I don't know if I'm even still live right now. The ticker's still going. I think you guys are still here. Anyway, so to talk about, back to this example, the margin call piece on Interactive Brokers is instant liquidation. They may, if you put in a bunch of notes about which stocks you wanted to prefer, they may choose to liquidate stuff, but typically what happens, they just liquidate everything, starting with what's most liquid. So instantly, the same day, I've experienced margin call on Interactive Brokers, and it's painful. I was an idiot, and I deserved what happened. I will recover from it because I am, a smart investor, and long term, I continue to make $10,000, $20,000, $30,000 a week. So it's only a matter of time before I have made it all back without taking significant risk. I could make, there's weeks where I've made $500,000 a week, but I have to take a lot more risk to do that, and I'm not comfortable taking those risks. So it's gonna take me a little bit longer because I got to, keep my risk management in place. Got to reduce that risk, be more diversified. So yeah, comparing the two, Interactive Brokers, the line of credit that they give you is automatic, no approval. With the bank, you got to go through an anal probing of like, send us all your leases and all your rental properties. Let us, comb through your bank statements. Let us check your credit score and all this other stuff. You got to go through an application process. You'll probably get approved if you have a good net worth. But on the Interactive Broker side, it's instant. You put the money in, the line of credit exists. You buy the equities, the line of credit exists. At any time, you can draw from Interactive Brokers at prime minus like less than 1.5%. Depending on how much capital you have with them, it gets cheaper and cheaper and cheaper at Interactive Brokers. The cheapest tier of borrowing at Interactive Brokers is 0.6% interest, which is like well below bankers' acceptance cost. The private bankers can't go below like 2%, whereas you can get at 0.6%. So it's a 1.5% difference in cost of debt. It's 400% cheaper to borrow from Interactive Brokers than it is to borrow from the bank, but you have a little bit less flexibility and you have to basically save more for margin calls. So I'm comparing the two. That's what's important. Hopefully you guys can hear me. I don't know if someone jump in the comments and tell me you can still hear me. Someone in the comments right now, or smash that like button. Let me know some engagement way that you can still hear me talking right now. Someone, anyone? Are we live even right now? Have I been talking to no one for the last little while? No, I don't know. It looks frozen. My timer isn't even moving right now. I don't know if it's the Wi-Fi, what's going on. It says it's on my cell data. I don't know. I don't know. There's zero chat. I don't see any chats coming in, so I don't know what's going on. I just saw some likes increase, so maybe people can still hear me? I don't know. I'll keep going and pretend that people can still hear me. Hopefully you can. So, Told Fable, Oh, sorry. So Brian, I'll answer the last 2 questions. Was there a clear winner? For me, the only advantage to being on private banking side is the lending. So if you want to go buy more properties, or you want to buy another house and you don't have good income because you're early retired, I think the private banking piece adds a lot of value. In that you can get approved for, you want to buy a business, you want to buy a property, you want to buy a new house, whatever, expand your lending in any way. The bank really looks favorable on, if I have a huge stock portfolio and I say, hey, I'm just going to pull out stock portfolio. They're like, oh, whoa, wait, we'll approve you for that loan. We have a contingency, loan space that'll allow for us to lend to you, even if your ratios don't work. That's a nice piece in the private banking side. They lean in and they can get it done. Pretty much auto approval on whatever I want to buy on the private banking side. That's the real value. If you're not buying any more real estate, you're not looking to borrow anything, you're not looking to do any lending from the bank, then Interactive Brokers is a clear winner. Like, you don't pay 1% a year fee compounded. You don't pay the management expense ratios. You don't have to pay 400% higher interest rate. Like, you can borrow at like prime minus a bunch. So it's for sure Interactive Brokers is better in every way, other than you have to manage it yourself. So that's a huge downside, I guess, for Interactive Brokers. Whereas you're paying for them to manage it for you. The hope is that if you're somewhat savvy, you can make a better return than what the financial advisor is doing for you with the standard basic S&P 500 type of portfolio that's probably just performing at market. I've been lucky. My private banking portfolio has been outperforming the index, but only slightly. Long term, it shouldn't outperform. I think my portfolio is actually outperforming like 20% higher than the index right now, but it shouldn't. Long term, most fund managers don't. And so I know I'm just lucky right now. For me, it's the other intangible benefits around lending that are key. So yeah, hopefully that helped. I still don't know if I'm live at all right now. I have no idea if you guys can hear me. There's no comment. I don't see any comments at all. All I can see is what was posted up till 7:22:23. So I don't know. Hopefully you guys can hear me. I'll keep going. If someone's watching this right now and it's terrible, just text me. Like, for those people who have my personal number and you're watching this right now, just text me and let me know. I guess if you can't hear me, then no one's gonna text me, and so just keep going. Tesla Q2 earnings were positive. Yes, they were. That's true. Where do you look for deals? Told Fable says. So depends what kind of deals you're looking at. Like, if you're looking for, I don't know. I just went over to cellular data again. I don't know if I'm live right now. I'm on cellular data, and the cellular data here is terrible too. I have 1 bar out here, so can anyone hear me? I'll keep going, assuming someone give a thumbs up, maybe. Just someone tap that thumbs up button if they can hear me. That'd be cool. I don't know. The timer is completely stopped, so I have no idea whether I'm on right now or not. This is the challenges of country internet. We're making the best of it. The next question was, what ties a company's valuation to a stock price? I kind of touched on this a little bit, but some of the important metrics to look at are overall, like, net asset value. So look at their books. What are some of their actual intangible net assets? So look at all the assets they have. Look at all the intangibles. All the tangible stuff too, like the fixed buildings, whatever, ships, whatever they own. And then look at all the debts on that. And if there's a net positive there, and then you factor in like a liquidation value. And if there's some good value there, that'd be a good book value. That'd be one way to look at value. Another way is to look at the earnings and look at sales and say, so how many times sales is this trading at? How many times earnings is this trading at? What is the trailing earnings for the last couple of years? Is it trending up? Hello, can you guys hear me? Am I live right now? I just switched back to Wi-Fi. It prompted me to try to switch back to Wi-Fi. This is so frustrating. There's nothing more frustrating than lag. As a gamer, I want to grab my keyboard and throw it across the room. As a streamer right now, streaming to you, I want to throw my phone across the room. Son of a... Throw this across this... Can you guys hear me? Hello? Hello, world? Can anyone hear me? Wait. The timer just started moving again. Can you hear me? World, can you hear me? Can anyone hear me? Am I live? Hey, we're back. I can see the chat. Hello, friends. We're back. Okay. I don't know how long this is going to last. So if it cuts out again, I'm sorry, guys. This internet is shite. It's just terrible. Even the cell phone service out here is just horrendous. The worst. It's fine for like, putting in a trade or just like on Instagram, but for streaming, it is not ideal. So Turner Harker says, tell us what options to buy right now. I can see his chat popping up here. And by the way, I think I can go back still and load the old chat. So I will go back to the questions here real quick and do those. And sorry if it cut out, and hopefully people can get back in and we can connect again. Yeah, so what do you buy right now? It depends. Like my morning routine is to wake up and I have a watch list of like 150 companies and I scroll through my watch list and I look for what's down. That's where I usually start. And I'm like, hey, what's on sale today? It's like open up the flyer when you walk into Rona and be like, oh, vanities are half off. Cool. I don't know. Let's see if who beats what. So Amazon's actually up quite a bit today. I closed out on Amazon, but Apple was down for a little bit at one point. If you look at all the different positions in your portfolio, there's got to be something that's down. That's what I sort of nibble on that day. If I see something that's crazy up, like irrationally up, as an example, GameStop, I often see will do a 10 or 15% high. AMC the other day had a 23% high. I entered a defined bear call, which means I'm basically shorting it, but in a defined range. So if AMC stays below, a price that's 10% higher than it is now, a week from now, I make a premium. And then I set up a spread, so I've defined risk. I don't lose a couple of bucks a share. It's not a huge gamble. But typically after a huge update, there'll be a bit of a bounce or a correction, and I just exit the contract. So I do, when I'm like day trading or like, looking for like some easy play, that's what I might look for. But typically I'm looking at quality names. Typically I'm going through my list and I'm like, okay, what is quality? Like Alibaba was on sale big time. Was it yesterday? Day before yesterday? All the days come together, but it had like 3-4 days in a row. There's a lot of fear out of China. And so there was a pretty good discount. I'm like, geez, these option premiums are up 200-300%. That's what I'm looking at, is what are the option premiums when they're way up. Or if I'm looking at on the crypto plays like Mara or Riot or crypto miners or MicroStrategy, if I'm looking at those plays, if one of those is like down 20%, I'm like, oh, I'll get some of that. At like half the current share price, they're still paying great premiums. I'll write some contracts on that. So it's I think that I like to have a portfolio so my ideal portfolio is one that's never more than 2% in any one sector or company. It makes it hard to actively trade that, but long term, like I wrote some stuff on McDonald's, it was down 5%. I love McDonald's. I think that they have a fantastic business model. It's very sticky. They'll be here for a long time. Their food's addicting as hell. That's an example of a company that like, I wouldn't mind owning McDonald's under $200 a share. So whenever it's really on a down day, I'll go ahead and I'll nibble away, write some contracts on it to say, hey, I'll buy it at 190 bucks a share. And when it's paying really well, like right now, I think it was an update today from McDonald's. So I wouldn't write any contracts today on McDonald's. I wouldn't buy any shares today because it's an update. I'd wait for a discount to get in. Same if I'm buying like SPX or any of the index, like SPY, which is basically the ETFs for tracking the S&P 500. On down days, like if this S&P 500 is a down day and it's a bloody 2-3% down, often their option premium market is like 30-40%, paying 30-40% more. It overreacts like 10x in the options market. And there's not a lot of liquidity, so the big guys can't get in on some of these more fringe trades. And so that's where I'll get in and I'll make premium when I'm looking on the day. So I'll look for what's happening in the day. Whenever the market is fearful about something, I'll look at it and be like, why? And then if I think that there's going to be a comeback from this, or like the whole China overreaction, Alibaba is a great company. I don't think it's going to be gone tomorrow. So I have no problem owning some shares in that, right? There are lots of companies like that, like Amazon or Google, or there's days where Google, Facebook, whatever, stuff like that's down 3, 4, 5%, sometimes 10%. On those days, it's fantastic to write some contracts to hopefully own some shares at huge discounts. Actually, hopefully not own any shares and just get money for nothing. Get the contracts to expire worthless, and I get to collect all that premium for nothing and continue to write those contracts. If I get assigned, that's okay. It's on companies that I want to hold long-term in a portfolio. Now, I have several portfolios, by the way. I have like an options trading that's aggressive. I have an options trading portfolio that's more long-term focused. I have a dividend portfolio. I have like a stable equities portfolio. So I don't keep all my eggs in one basket. You got to spread it around and have different portfolios. That's a key piece. Interactive Brokers, IBKR, is the best platform that exists in Canada, bar none. The margin costs are like 400% lower than they're like 800% lower than Questrade or any other crappy brokerages. Questrade's terrible. When you stack up Questrade to Interactive Brokers, if you have any amount of capital, like you have more than 50 grand, Interactive Brokers blows Questrade out of the water. Like the fees are better, the trading liquidity is better, the data is better, most importantly, the margin requirements are better, and the cost of debt on the margin requirements way better. Like we're talking prime minus, whereas Questrade's like prime plus, prime double prime, triple prime in some cases, depending on what you're borrowing against. Some of the rates are really, really dirty high. Some of the riskier plays, like if you're leveraging to buy like GameStop or AMC, the margin costs are a lot higher than if you're borrowing to buy like McDonald's or Google or Walmart, like quality names. On my dividend portfolio side, I like the utility companies, the stable TELUS, Bell, Rogers, and the oil stuff. I like the Enbridge, the Pembina, the Suncor, the BP, you nibble on all of those names. I like all that stuff. On the down days, like when I see Suncor dip 10, 15%, that's when I start running contracts and they're 10, 15% below that. When a sector, like I'll look at whatever sector's down that day and I want to have a little bit of everything as the goal. I don't want to just be in oil and gas. I don't want to just be in tech. And I do go a lot into tech because I think tech is the future. Any company that's not focused on tech is going to be dead in 50 years. But, I like to follow the trends, like the EV trends. I like NIO. When NIO is getting beat up because of the China fears, the same time as Alibaba and JD and all the rest, we're getting beat up by the China fears. NIO, I love what they're doing in the swappable battery space. I think that they're a company that could be $60, $70, $80 a share a year or two from now. And so I don't mind writing contracts. I have some contracts out right now that I might have to own the shares at $29 a share, which is like, that's a worst case scenario. I either get money for nothing, or I might have to own the shares at 25% less than they're trading at right now. So that's an example of like a little bit of that in the portfolio. That's okay. I don't think that buying and selling shares makes a lot of sense when you can just use options to achieve the exact same thing with less margin requirements and a better overall payday. So I like to use options as opposed to just buying and selling stock. Buying and selling stock is a zero-sum game. I like the theta decay. Theta decay is the idea that you write a contract and over time it decays, right? So if I agree to buy your shares at a set price a month from now, there's a lot of mystery. A lot of things could happen in the next month. But a week from now, or let's say it's the next day it expires, like when we get a month later and it's the day before expiration, there's almost no IV, there's almost no risk there, to put it in like layman's terms. There's a lot less risk there in the, sorry, someone just texted me, I was reading the text. There's a lot less risk there, as time gets shorter and shorter. A lot less can happen. So if I agree to buy the shares at 30% less than the current price, by the time it's a day away from expiration, that contract's worth almost nothing because there's almost no chance that it's going to drop 30% in one day. It could, but the probability gets very, very small the less time. So the further out you go, if you agree to buy, like if you write a contract 6 months from now, usually what happens is it starts decaying in the last 60 days, 45 to 60 days, it starts to decay. If you're looking at contracts a year from now, there's almost no decay in the first 6 months. So I always write stuff 60 days out, and I'm always looking to cash it out in like the last 3-4 weeks, typically. If I get an update, I might, I have stuff that I've written for November expirations. And if it goes up, if it's 60% of the premium is realized already, hell, I'm gonna cash that out, right? Like if I got 60% of the premium already earned on an up day, let's say, or if I'm shorting a down day, but if it's an up day on the stock and I'm bullish on it, right? I'm long on the contracts, I'll close it out. Because am I going to tie up all that capital, all that margin that's tied up on that contract? You have to put money up, right? A percentage of the price that you're going to pay for those shares. It's a smaller amount, right? If you're agreeing to buy $100,000 in shares, they might make you put up $20,000 or $30,000 of capital tied up into that position, right? So it's not as bad as owning the shares. You don't have to put that much money up, which is why returns are better. But you still have to put some money up. And so if I have to say, hey, is there 2 months left or 3 months left till that contract expires, and I can make 60% of the money right now, I'll just close it out and look for the next contract, right? So often I'm closing contracts out the next day because they'll just, in the swing of a day, sometimes it'll be 50%, on the premiums, it might be $1 a share. It's paying me $1 a share premium. to insure the contract, and then all of a sudden it's 40 cents a share. And I'm like, whoa, someone else can have my contract. At 40 cents a share, you can have the contracts all day, buy them up. I just sold them at $1. I'm cool to buy to close at 40 cents. I'll take 60 cents for nothing in a day. Those are the kinds of trades I really like. Just that market fluctuation. I like to just take advantage of that. With, again, the focus on trying to build a portfolio, hoping to nibble down, focused on risk management at the end of the day. Do you know if any line of credit you can secure against your stock portfolio? So Mr. Pipton, just go back like 10 minutes ago. I spent a good 5 minutes talking about lines of credits secured against stock portfolios. So in private banking, they do it all day long, 70% loan to value. At Interactive Brokers, you don't even have to apply for it. You have $1 million in shares, you bring them over to Interactive Brokers. If it's at Quest Trader right now, you bring those shares over to Interactive Brokers, open up an account, journal them over. Boom, they'll give you a line of credit, 70% loan to value at prime minus 1.5%. You can borrow against your stock portfolio cheaper and easier than borrowing against real estate. I didn't know this. Mind blown. Like 3 years ago, I figured this out, and I was like, whoa. I didn't realize everyone around me has mortgages on their stock portfolios, and that's awesome, right? Like, and that's way cheaper than what you can do in the mortgage lending space. And at a certain point on the real estate side, you start borrowing at 75 or 80 or 70% loan to value anyway on commercial stuff. So the loan to value is the same. The risk is in the stock portfolio, you can get margin called. Whereas on a mortgage, you're not going to get margin called. They're not going to call your loan. On a stock portfolio, they could call a percentage of the loan if the stocks dip in value. They won't call the whole loan. They'll say, hey, make up how much you're short. So you have to liquidate some positions to then make up what you're short. And you have to liquidate quite a bit, like typically maybe 3-to-1 to cover. So if your portfolio drops 100 grand, you'll probably have to liquidate 300,000 in shares to cover all that, to cover all that, which is fine, like you just gotta be prepared for it. What I would think would be a more prudent strategy if you're building a risky portfolio is buy some puts or sell some, call spreads and sort of short, all the time, collecting that decay of premium so it doesn't cost you much to insure. But if there's a black swan event and we drop 20% overnight, guess what? All those puts you bought or all those bear call spreads you sold, they're way up and you're in the money. And then you can close those out and you have cash to cover the margin call. So that's a good idea, is to insure your portfolio against risk. And options allow you to do that. You can basically insure against a recession. And then you have gunpowder, like your insurance pays out big when the market cracks. It doesn't in a bull market like right now, it doesn't cost a lot to insure the S&P 500. People are bullish. So there's a lot of people out there who will sell you that contract and agree to insure your portfolio against a dip of, say, 10%. I write them all the time, 10% dip contracts. I don't do it on down days. On up days is the time to buy insurance. When the market's at its all-time high, when there's the most positive energy, when they're like, hey, it could go to the moon tomorrow. Like everyone's super enthused, everyone's bull. You go on all like BNN and everyone's like super happy and everything's all green. That's the time to buy the insurance. That's when it's the cheapest. And then the time to sell off that insurance, if you're trying to, cover your cost of insurance and continue to sell the insurance before it expires, and then you write new insurance contracts to protect your portfolio. The time to do that is on the down days when everyone's afraid. After there's been a huge, correction there was one on Monday. There was like a 3%, 2-3% pullback on a lot of great names. There was a lot of fear. That was a good time to get in and to nibble away, right? Or was it Friday? I don't even remember. All the days blur together. But there are down days, and that's the time to do that, right? And so, yeah, I'm going to try to bang out some questions here real quick. Would you invest in real estate out of state for higher returns than in your area? Alex, yes. I have a plan to invest out of my local market. My local market doesn't make any sense anymore. There is a strategic benefit to being close by your portfolio. And if I was starting again from zero, I'd still invest in my local market. I'm at a point now where I'm going to outsource either way. So there's no strategic benefit to me being owning properties close to myself, because I'm not going to drive to the property. I'm not going to check on it. I'm not going to go deal with that property management issue. I'm going to outsource it either way. So if I have a power team here or a power team in another city, not a huge difference. And the cap rates are double in other areas. So I am, cognizant of taxes is the reason I haven't liquidated my whole portfolio. To be honest, like that's really it. I don't want to pay a huge tax hit, but there may be a day where I just decide I'm done. I'm done with London and liquidate my whole portfolio. I've got millions tied up in equity that's not earning me that much cash flow. Like I don't know, my real estate portfolio probably could cash flow like, in a best case scenario, 20,000 a month. In a best case scenario, 30,000 a month, maybe. I could take all the capital in my entire real estate portfolio right now, put it in an options portfolio and make 50 or 60. The reason I'm holding, appreciation. I'm worried that it's going to appreciate another 20%, and I'm still levered pretty good in my real estate portfolio, that I'm worried I'm going to FOMO of more of that real estate appreciation. And part of it is tax too. I still want to pay that. I bought properties for like 160 that are worth 450 now. They're triple. And so I've already refinanced them, and literally the 20% equity that I have in the property is the tax bill if I sell. So on some properties, I'm like, okay, there's no point in selling at all because I get nothing if I sell. Might as well keep it and get a little bit of cash flow, not pay the tax to the tax man until later. But I refinanced so that my 20% equity is just tax owing at this point because the property's just gone up so much in value. Part of it was, at one point I renovated it and added some real value to it, but then the rest of it was just appreciation and right time, right place. So yeah, that's what you want to do. You want to set yourself up so you have a nice portfolio that's the right time, right place. And if you've got a whole bunch of fishing lines in the waters in many different sectors, many different businesses, when the tides eventually rise, which they do for investors in every single segment eventually, it rotates which segments, the hottest and the best. Is it value stocks? Is it growth stocks? Whatever. Is it real estate? Is it crypto? So it rotates at the end of the day. And so yeah, US is probably where I'll be expanding. I've got my eye on Florida. It's a beautiful place. Warmer states, warmer red states that are very pro landlord. I want rules. Like here in Ontario, there's a tenant can go a year without paying rent. It's brutal. There's some really terrible rules here. I've talked ad nauseum about it in previous episodes of this podcast for the last 3.5 years we've been going live. So at my stage in the game, it's just about what do I enjoy too, right? That plays big into it as well. I want to do a video just on like real estate versus stock option trading. I think a lot of people have equity trapped in their properties, which should be reallocated, but they're just, naive. Because you got to remember, 1% of investors are active traders, approximately, and 1% of active traders are options traders and derivatives traders. So very few people even understand how to write a bull put vertical spread or a call spread, right? They just don't understand how to even, what is a call and a put? Like put is you're basically, well, if you're selling the contract, you're agreeing to have the shares put in your account. If you're buying a put, you're agreeing to put shares in someone's account at a certain strike price. Call is, hey, I'm going to call and I'm going to get the shares from you at said price. So call and put, that's it. And you can buy a put, sell a put, you can buy a call, sell a call. You could use both to be, you can use a put to be bullish or bearish. You can use a call to be bullish or bearish. People often think puts are always associated with shorting. They're not necessarily. Some people think calls are always bullish. They hear the word call, like, oh, it's bullish. But like if you're selling calls, you're actually shorting the market, right? So it's really, it's that basic understanding. Go to tastytrade.com. It's free. They have free courses on options trading. I haven't finished them all yet, but someone sent it to me. A friend of mine sent it to me, and I checked it out, and it was fantastic. Also, Erwin has a Canadian course. After you finish Tasty Trade, he's got an advanced course with Eddie. That's what I'm going to actually take when I have more time to really understand charting and the technicals. And I think that's important only for the entrance and exit. My overall strategy hasn't changed, but I feel like the entrance and exit is super important, and understanding, when do you get in and when do you get out, right? There you go. Mr. Pipton's on there talking about Tasty Trade being great. They have a fantastic platform with tons of free courses, cost you nothing to get started. And then once you have an understanding of what a put and a call is, I learned it in school and then just Google. Went on Google and was like, did a refresher. There was like a free Investorpedia. I just like spent a couple hours reading it, and then I started practicing. And I got better the more I lost money. Like today I was with my daughter. We were sitting outside, and I clicked the wrong button by accident on my phone, and I sold something at the ask, and I bought to close something at the ask instead of the bid, and it was a huge spread, and I lost like $2,000 with the wrong click on my finger. That's an example of like just stupid rookie mistakes you make. I've been trading on my phone because I'm out here at the cottage, and trading your phone is super, super easy. But that's an example of like just not paying attention. Daughter was screaming on my lap, and I just clicked the wrong, wasn't thinking. It was like, I thought I was, I didn't realize I was buying to close out a contract. I thought I was selling one. I'm so used to clicking the ask price. I clicked the ask, but I should have been clicking the bid price. So it went filled instantly. And I was like, oh no, it filled at like the worst price possible. So that happens sometimes, big mistakes along the way, but you want to do those when you're just getting started and with small amounts. You don't want to If you have $10,000 in your account, don't write a contract for worth $6,000 on Apple and then write another one for $4,000 on Tesla. Like then you're all, your Stock Hacker Academy does have one. That's Erwin Cizito's course I was talking about just a minute ago. That was the Canadian course I was talking about, which I have a referral link for. If you want to join that, you can get a discount using my referral link. I can make some money too. It's kind of cool. So message me on Instagram or tell Erwin that I sent you. Anyone watching this who knows Erwin, send Erwin a message and tell him I'm plugging him. He'll get a kick out of that. He'll enjoy that. We got to support each other. We're all, all brothers in real estate and in stock trading. So I like this as a community, and it's really awesome to have that. In real estate, I wanted to create that too. There wasn't one in London, and we sort of created that, right? Same with the London on Fire, with the financial independence, retiring early movement. There wasn't a huge, when I started this back like 17 in my dorm room, so I was 11 years ago, something like that, 2010. So in 2010, when I found this, there was no one online talking about it. There was Early Retirement Extremes, Jacob Lundfisker, who had wrote a book. That was it. Mr. My Mustache wasn't even a thing yet. So there was just, there wasn't a community. There's millions of people doing this now. Anyone can retire early because all the information's out there. It was hard before. And so in a lot of ways, you're just finding this now. You're blessed. You're 5 years, if you found this video right now and you're watching this, you could be 5, 6 years from retirement right now. You never have to work another day in your life if you don't want to. All the keys are there. You just got to learn how to put them into the lock the right way. You got to make some conscious choices. Enjoy his podcast. I was saying he makes more off his investments than YouTube. I don't think Erwin really has much of a YouTube. His podcast is pretty big though. I would say that Erwin makes, I don't want to talk shade. I like Erwin a lot. He probably makes the most from his real estate, active sales and his businesses, to be honest, than he does probably trading. I don't know. I actually don't know. I'm just speculating at this point. I have no idea. Even if I did, I probably wouldn't say. So yeah, he's doing a good job. This guy makes more from his revenue from YouTube. So I actually make nothing from YouTube. I've disabled the ads entirely. So you'll see there's literally, when this goes back on playback, there are 0 ads. So I make nothing from all of these, zero. If you super chat, I make a super chat. I literally lose money doing YouTube, and I don't do any coaching calls at all. I reject all the coaching calls coming in because most people just want to pay me a couple $100 an hour to coach, and that's low value. If you want to go on my Instagram, Mike Rosehart, I have hundreds of saved stories. You can go check it out. I post every single day. Most of my trades, you can see for yourself. For the last 4 years, I've been documenting on Facebook and Instagram, mostly on Instagram, all my properties. You can literally see, I made a mistake and I posted one of my accounts. I had $6 million on one of my trading accounts, and I posted that and showed that for a second. So I think I deleted that story because I didn't want people to see how much net worth I had in that stock portfolio. But you can go check for yourself. You see my daily earnings. It's hard to fabricate, screen recordings daily all the time. That'd be a lot of work for me to do and for zero benefit, because my Instagram following makes me 0 and my YouTube makes me, my old videos do make me something. So I think I'm maybe $290 a month. I think I make from YouTube from all my old videos from years ago. Some of them still have ads in them. Anything new I create has no ads. So yeah, it's this guy's new. He's never followed me before. I'm glad though. Find people like you joining my channel. You've obviously found my video, which is sweet. That's exactly what we're trying to do here, right? I have lots of losses. Go back 4 weeks ago, look at my Newegg short. I lost $1.5 million in the span of 4 hours. I posted that. That day was a 7-figure loss day. It was terrible. I learned a lot from that. So I got lots of losers too. Huge losers, right? But generally, I've done pretty well. I've made lots of money, and I might have a bad learning curve, but once I've learned, then I try not to make the mistake twice. So that's yeah. Mike, what other asset classes are you in? So I'm in a ton of asset classes. I have a crypto mining operation going, which is an active business. We've got, 4 gigahash a second. So 4,000 megahash a second farm going right now in 4 locations. And that sounds more elaborate than it is. It's really not. I have a little shop that I'm renting. It's got 4 rigs in it. I've got another one that's got a couple rigs in it. It's not elaborate at all. Just a little experiment. I will be blowing that up. I plan to put about $1 million in machinery together at my new place. We'll see. I don't know. Maybe 500,000 in machinery. But the cool thing about crypto mining is I wanted to build a network as well of Bobcat miners too, and you can do a lot of stuff without using a lot of power, using IoT technology where you're basically providing just like a location to ping off of. Yeah, so anyway, it's all, to me at this point, at this stage in the game, I've got so many little businesses and things that I'm invested in. Like, I have a bazillion flips on the go right now with a few active partners, right? I've got the stock options trading. I've got a dividend portfolio. My dividend portfolio, it does like 25,000 a month. My dividend portfolio does 25,000 a month. Like, if my entire options account blew up to zero and Newegg short blew my account up, I would be devastated, by the way, because that took me years to build. But the point is, I've got so many firewalls set up that I'm financially independent or retired early, like 11 times over now. So it's, we can have a conversation about what you need to retire early. It's a lot less than I have, that's for sure. I'm not trying to brag. I'm just like, I've done it. And I'm trying to tell you from experience what not to do and what to do. Yeah. Matthew popping on here says, every Wednesday for 3 years. That's right. So one of my first ever streams, Graham Stephan was staying at my place. Kevin and Graham came to London. I don't know if you follow Meet Kevin Pathpath, and Graham Stephan. Graham's actually my first ever Mike Rosehart show, the Wise Wealth Show. I think I called it the Money Monday. So Graham Stephan was on my channel, and we were sitting in my office back before I had, like, I was nothing back then. I maybe had like $1 million, $1.5 million. This is not even that long ago, like 3.5 years ago. Maybe I had like 2 million max. I was just a young 24-year-old, early retired. Now I'm gonna be 29. Ooh, getting old. 28 right now, but I will be 29 shortly. So I'm getting older. I started this journey at 17, and it's been a grind. I've consistently put in the work, but yeah, it's fun going back and thinking about back when Graham and Kevin were approachable, back when you could have a conversation with them and they weren't getting 1,000 DMs a day, right? Yeah, those guys are good guys. Those guys are good guys. Kevin's a really hard worker. That guy's insane. Like, he has the same work ethic I do, but like, he's stuck with the right focuses, I think. I get very shiny object syndrome. I've dabbled in property management, and I built a construction company, and actually Kevin built a construction company, and it went the same way as mine. They both went to shit. Yeah, and Graham's awesome too. Graham just tells shit how it is, and he has a great on-camera presence in a way that I don't. And like, watching him on his iMac, or sorry, his MacBook, editing his videos. Like, he did, I don't know if he just still does it himself, but for the longest time, even when he had like 1 million subscribers, he'd be messaging me, and he used to watch my Facebook daily streams. It's how we connected, is he'd watch my daily streams on Facebook. And Graham would the amount of effort he puts into his editing his videos, like, he'd reshoot a take, like, he'd reshoot the video again if it wasn't good enough, or he'd edit it so well, whereas like, my approach is like, it's good enough, just put it up. And that doesn't work well for YouTube. So that's why I didn't do well with YouTube. I didn't put the effort into it. Those guys put the effort in. They honestly deserve more subscribers than they have for the effort that they put in. Like, especially Kevin doing a video. He was doing like 2, 3, 4, 5 videos a day at one point. Like, it was just, I can't even watch the content that he creates. It's just too much, in a good way. Like, not in a bad way, in a good way. So, yeah. Love those guys. Awesome. Just good guys. Yeah, good guys all around. It's fun. And they've skyrocketed and blasted off, and here I am with hardly any social following at all, but it's cool. I got my little cult. You guys join me every week. We have a good time. I don't spend any money in growing this at all. So that's why it doesn't grow, but maybe someday. That's why I keep it going. That's why I keep coming every week. People are like, why do you keep coming, Mike? I'm like, there might be a day where I wake up and I want to write a book, and I want to build a couple courses, and I want to start pumping out videos again. There might be a desire to do that. Like, I'm thinking maybe my daughter. She's my oldest is, I have 3 daughters. My oldest is 5.5. And by the way, that slowed me down a ton. Anyone watching this thinking about having kids, it will slow you down big time. If you want to be a good parent, I think it slows you down a ton. I just don't have the time to make the videos. But I'm wondering, maybe someday my daughter will be into tech and want to edit. If she ever wants to make videos with me where we teach financial literacy to kids or whatever, like, I'm so excited for my daughter to be like 10 and have the drive to do that. That's 4.5 years away. Like, that's wild to me that's why I keep this going, because I think that someday this will turn into something, some fun project. And also, it's a good outlet. I enjoy just coming on here and shooting the shit with you guys. And a lot of my friends watch this too, and so it's cool. They get to catch up on what's up, and they'll message me and be like, yo, dude, I caught your stream. That's cool. This is happening, or that's happening, or whatever. So, yeah. Danny, so I'm not proud of this. A lot of guys are proud. Danny asked how many hours were you sleeping in the beginning. So I've always been big on sleep. Sleep's super important to have good cognitive ability. You need to have good sleep. Like anyone who says you can live on less than 7 hours sleep is lying to themselves. You know, there's like 0 people in the world that function well under 7 hours sleep for extended periods of time. So sleep is important. There were many nights where I did do 4 and 5 hours sleep with a nap. Don't recommend that. You shouldn't do that. I did put in 16 hours often, consistently, but you don't need to do that. You could work smarter and, you know, still grow at a great rate and still retire early. You don't have to work 3 full-time jobs to get there. Just work smarter, not harder. I made a lot of mistakes along the way, and that's each mistake. As an example, I was supposed to be on the beach every day, not trading at all, with passive contracts checking on weekly or bi-weekly, but then I blew up my entire account. And now I have to trade every day. I have to watch for deals. I have to, you know, hunt through hundreds of stocks to find deals every day. And that's a big piece of it, right? I gotta wrap this up. My daughter's back. Okay, I'll pick one more question. Nope, no, on the camera. Mom doesn't like you on camera. I will pick one more question for you guys. Hang on, sweetie. Someone says, so Paul says, I'm so stuck on direction on the market right now. I feel like there's a big correction around the corner. What do you recommend or suggest for options plays in this market? So Paul, if you're not sure what's going to happen, just strangle or straddle the portfolios that you like. You could, you know, just get some theta decay. You could write contracts where whether it goes up or down, you've capped off. And so long as it stays within a band, you win. And over time, it will just decay and you'll be good to go. So that's what I recommend. Bryce, I think that you need a good amount of capital to really have an impact doing any options trading. I think real estate is the place to start for almost everyone. If you have less than 100 grand, I think it's important to invest in, sorry, my daughter's like right beside me right now, just off camera right here. I'm coming. I gotta wrap this up, sorry. My 3 kids are about to come in and make a storm with the dog. Yeah, so my point being, what was the point I was gonna make? I think that you really need a considerable amount of money to really have an impact with an options portfolio. So if you're getting started with 10 or 20 grand, you can play around with options and have a little bit of fun, but without taking extreme amounts of risk, I think 1% to 2% a week is a maximum. Like I kind of target with a really stable portfolio, 1% to 2% a month with options contracts. So, and that's with writing several different companies. So I think, you know, if you had 10 grand, you should expect to make like $100 a month. You know, just getting started. And if you get better, maybe $200-300 a month, $400 a month, maybe. Whereas you could take 10 grand and maybe lever that up to maybe get into your first property and make the same amount of money. But then all the appreciation upside as you renovate the property and fix it up and add value to it could take your 10 grand and turn it into 100. You can't take 10 grand and turn it into 100 like you can in real estate in the stock market. But if I have 10 million to deploy, I can grow it just as fast with an options portfolio than I can in a real estate portfolio. There's just no time. I have to put the time in that I have to put into a real estate portfolio. Less risk, less stress, better liquidity on the stock options side. So anyway, I gotta wrap this up. Everyone's back. So thank you so much for watching, everyone. I really appreciate everyone tuning in. And I am shadow banned on Instagram right now, so it's nearly impossible to tag me. And all of my stories won't, if you watch my stories, try to engage with them. If you want it to show back up in your story queue, you gotta engage with it like 10 times because I was sharing a bunch of COVID stuff and sharing a bunch of stuff that didn't align with the narrative. And they gave me a warning. And then my story views went from like 2,000 something a day to like 200 the next day. So it's, yeah. So Bryce, you've definitely got a net worth that's worth diversifying. I was like you, like 4 or 5 years ago, I was in the same position you were in. And it's about smart to get out of real estate. I think the ideal asset allocation depends on your time. It depends on your time and all that kind of stuff. But you maybe really enjoy real estate and you like managing a portfolio. But if you value your time, I think that with a net worth like that, you could have $1 million in a stock portfolio, borrow 700,000 back out, invest back in real estate. Like you could sell your whole thing, get 1.6 million out, or let's say sell a few of your properties, get $1 million out, and then get $700,000 line of credit out of there and go buy a bunch more properties. And still have $1 million stock portfolio with $700,000 line of credit against it, and now you're a bit more diversified. You're not just all in real estate. You've got $1 million stock portfolio as well that you can play around with it. So that's an idea as well. I think having diversity is important. If you can invest in some private businesses, some publicly traded stock equities or options contracts, a nice dividend portfolio, a little bit of crypto, I think you should nibble on some of that. All that stuff is key to building wealth long term. Diversity. You don't want to be in all one sector. That means real estate as well. And I'm as bad as anyone else. For a long time, it was like 90% of my net worth is in real estate. And still now, probably more than half of my net worth is still in definitely more than half of my current net worth is still in real estate. Maybe even 60% of my current net worth is in real estate. That's bad. Like, I don't want that. I want to have less in real estate, right? But I'm working on that. The problem is good deals keep falling in my lap. I keep buying more properties as I sell one off and when I buy, so it's so hard. I am working towards less, a better asset allocation. Do as I say, not as I do, guys. That's all I gotta say here. Learn from my mistakes. Thank you for watching, everyone. The secret to unlocking wealth for you is to spend less, earn more, and maximize returns on the difference. That's it. A little bit of frugality, a little bit of, side hustle, pick up a little extra income, and then get your capital working harder for you. The more capital you have, the more important number 3 step is the maximizing returns. Now at my stage, what I spend and what I earn don't really matter. There's no way any active job anyone can hire me to do will even have a dent. Like if you had $20 million, let's say, a 10% return on that is $2 million a year. There is no job anyone can hire me for that would make $2 million a year. My portfolio makes more than I could ever actively earn. So my time, there's no point in me working a job anymore. I should just focus on tending to my portfolios and getting the maximum return. That's where my time is best spent now. Literally a job making 200 grand a year would be a waste of my time. I'm actually making less by not focusing on my portfolio. So anyway, that's the point I gotta make for today. That's the learning outcome. Bye everyone. We'll see you next week on Instagram, Mike Rosehart, and every week live for the last 3.5 years. Here I am, 7 to 8 p.m. Eastern. If I missed your question, put it in the comments, copy it, put it in the comments here. I check all the comments on YouTube and I'll answer those for you guys. So, all right, everyone, have a good Wednesday. Oh, hopefully next time you see me, this will all be gone. This dirty, gross thing will all be gone because I'll be back to break even of where I was before I did that whole Newegg short that blew up my account in the options trading portfolio. Bye, everyone.